Welcome to 10-9 Explained. This is exactly the same problem, different numbers, than 10-8, so we're going to run through it rather quickly. I've taken the liberty of drawing out in T-account form all of the accounts that are found that are going to be closed, pulled off of the trial balance. So the revenues, we're going to run through this rather quickly, so hold on tight. $6,900 and $2,400. These are debit transactions, and they total how much? $9,300. If these are our debits and it gets closed into our income summary is going to be totaled at $9,300. That's our first account types that get closed. The second one is going to be our expenses, another compound transaction. So we need the sum total of all of these. 3,800, 800, 2,900 is going to be $7,500. So let's quickly close these accounts. 3,000, 800, 800, 2 grand, 900, and that is going to be accounts 2. So if these are all of our credit transactions, that makes this a debit transaction going into our income summary. So there's number 2. Now these accounts are all closed. The third account that gets closed is actually the income summary itself. The balance of the income summary is the difference between the two. There's no increase side or decrease side to speak of per se, but the balance is going to be the difference between the two. After these two numbers fight it out, who's got anything left? You're going to say that there's going to be $1,800 in the income summary. Well, we need to close that into the capital account. So we're going to say if that's $1,800 credit, we need $1,800 debit. And if that's our debit, here's our credit, 1,800. Almost got myself mixed up there. And that's our transaction. That closes the income summary. The fourth account that gets closed is the withdrawal account. Well, that's a normal debit balance. There's 3 grand there. There's our fourth account. This gets closed also into the capital account. If this is our credit, this will be our debit, $3,000. Okay, fair enough. And that closes these accounts. So let's just, for the sake of argument, because you're going to have to confirm for yourself after you've done all the journaling of these transactions and the posting of these transactions, what your capital balance is going to be. If your capital balance doesn't match the number that we've come up with on the drawing, then you've done something wrong. The difference between the increase side and the decrease side is going to be your balance. And that is a total of, let's see, $23,600 and $1,800. Subtract $3,000 and you're going to come up with $22,400. That is your capital balance after all of your closings have happened. So when you're doing your statement of changes in owner's equity, and you're looking at it from here, your statement of changes in owner's equity, the ending capital balance is going to be $22,400, right? So ending, that's not very bright. Ending capital balance December 31st is going to be $22,000. That's this number right here. $22,400. Right? Was there a withdrawal to speak of? Yes. Now this is kind of going backwards, but this is how it works sometimes. And that was $3,000. And we can very quickly do this. The beginning capital balance, very interesting. What was the beginning capital balance? Well, if you're reading this question, you don't see anything that says anything about investments being made during the month. And if that's the case, there's no additional investments by the owner, the beginning capital balance is going to be the same balance that we had on the trial balance. So you should see the same number here. Here is your capital balance, $23,600. So your beginning Capital balance from what? December 1st is going to be $23,600 because there's no additional investment by the owner. Let's put it that way. But we did incur a net income. If you did your income statement, you would realize that the difference between the revenue and the expenses came up with a net income. Now, how much was that? Well, if you took it all total, you would say that your net income was $1,800. Excuse me. If you want to look at what your net income was it not found in your closing on your income summary account? So that's $1,800. The subtotal would be the balance of these two. There's a line there, it's hard to see. And that's going to be $25,400. Subtract from that the withdrawals, right? You're not going to put that in there because it won't let you anyway. That gives you an ending capital balance from December 31st of $22,400. That is going to be an important number when you go to do your post-closing trial balance. And I'm going to pause the recording right here for a second. Okay, very quickly, let's do our post-closing trial balance. The number that we've gleaned from the statement of changes in owner's equity is going to be very key for this. So the capital balance, December 31st, is going to be this $22,400. That was our ending capital balance. The screen kind of moved on me there. And so you can see that the numbers are $22,400. That's our ending capital balance on December 31st after doing our statement of changes in owner's equity. And that's the number you're just going to simply come over here and do this first so you don't mess it up. Come over and put $22,400. What other numbers are you going to get? Well, let's get rid of that. And call that up. I'd like to know what just happened there. I'm going to pause this for a second. Okay, that almost turned into a disaster. Because now we have the capital balance that we've worked up. All we need to do is plug and play all of the permanent accounts, which means not the withdrawals, not the revenue, all this stuff. This is another good. So we're going to just ignore that, and we're going to take everything from the capital, using the number that we generated for it, and plug it in over here. So cash in bank, $6,000, 1,500, 600, 200, 7,000, 5,000, and 8,500. Our payables were 2,800, 1,600, and $2,000. If you add up both of these columns, okay, add up the debits, you're going to come up with $28,800. And if you add up your credits, $28,800. I don't know if that's going to automatically calculate it for you or not, but just in case you don't have to. You have to do it yourself. Now, that sums up the entire question, with exception to that very last one where it says identify the account with the largest expenditure. A term that perhaps you're not familiar with. An expenditure is something you spent. You see it in there somewhere? Spent, expenditure. So anyway, you need to go back to your expenses, because that's the money, the money you spent, and find out what is the largest number. What is the largest expenditure? Well, let's just say these are your expenses. Don't need to be a rocket scientist, but I would say that $3,000 in ad expense is our largest expenditure. that concludes Working Papers 10. Albeit I didn't do every single computation for you literally. I did it in graphical form. All the answers are buried in there somewhere. If you follow the process, trust the process, you should be finishing up Chapter 10, Working Papers. Wish you well. I will see you guys soon. Godspeed.